Welcome to Real Talk, Real Estate Discussions with Andrew Kirsh. In each episode, Andrew interviews industry leaders. We'll hear their real-time opinions on today's market, their background and unique career highlights, and guidance for newcomers into the industry. You can find this show at sklarkirsh.com and on YouTube, LinkedIn, Apple Podcasts, Spotify, Google Podcasts, and more. Now here's the host of Real Talk, Andrew Kirsh.
Episode 75 of Real Talk, or I think it's episode 75. When you turn 50 years old, you lose track. I know I mentioned in my last podcast that I was turning 50 the day the Jeff Karsh podcast dropped, and now I am officially 50 years old. So it took a couple of weeks to launch my first podcast after my 50th birthday. Thank you to my family and friends who welcomed me to my second half century of life. I appreciate it. On this week's show, I have Andrew Gindy, the founder of Range Equity Management, otherwise known as REM or REM. I like to call him Andy. Most of his friends call him Andy. Don't call me Andy, but we can call him Andy. Gindy is one of the most, let's just say, wisest 30-year-olds in our business. Everyone loves Gindy, has great perspective on the real estate market, great personality, great conversations, and a great podcast guest. And so I hope you enjoy my conversation with Andrew Gindy. Welcome to another edition of Real Talk. I'm here with my good friend, Andy Gindy, REM founder. What's going on, Andy?
How are we doing, Kishka?
So I'm Kishka and you are Shayna Putham. Do you want to give our audience a little context of why we have these nicknames?
Why do we have these nicknames?
Well, our good mutual friend, David Schwartzman, who was guest number 2 on the podcast. I think you may be 75. I cannot believe I've done 75 of these things.
Well, that's how we know where David stands.
No, it's because I don't think Walton Street would have allowed you to do this. Is that true?
Happy to be here.
Oh, good. You're already dodging the first question. So Schwartzman gives everybody a nickname, and maybe it's a public consumption nickname and then a private nickname. Yes, I do have 2 nicknames. I'll let you say the 2.
Kishka, or Little Jesse, as David likes to call him.
Yeah, LJ.
Kirsh.
LJ. That's right. LJ.
That's right.
So I don't mind the LJ of the J part. To be compared to Jesse Scharf is definitely a compliment. You know, the little, yes, we are both not the tallest, and I've always been a little self-conscious about that. So to have LJ as a nickname, it's like a dubious nickname. And Kishka, he actually went to college with my sister, and he called my sister Kishka.
Oh, that's where it came from.
That's right.
That's right. That's right. I
forgot
about
from
that.
His USC days.
Wow.
So, and you are Shayna Putham.
I'm Shayna Putham.
And why are you Shayna Putham?
Look at this face.
But what maybe my audience doesn't know what Shayna Putham means.
Pretty face in Yiddish.
In Yiddish.
Yes.
That's great. So enough about Schwartzman. Let's talk about Mr. Gindy. REM.
Yes.
Do you go by REM or REM, like the musical group?
Well, you can call us whatever you want.
All right. So what do you want us to call
stands
it?
for Range Equity Management. And we do a lot of different things, hence our range. And REM is really important to me because my grandfather started a company 50 years ago, and it was called REM. I bought it in the classifieds, sight unseen, and so I wanted to honor that legacy.
Wow.
And you can call us REM, Range, whatever you like.
That's amazing. Did the band REM...
You're the first person to ever bring this up to me.
Really? That's what I thought.
We get a lot of that, too. And REM sleep, too.
Of course. All right. We'll talk about REM or
Yes.
range
Yes.
in a few minutes. Let's talk about the man, the myth, the legend, Andy Gindy. Not a lot of people know the inside story of you. So why don't you talk about where you grew up and a little bit about your background?
Sure. Grew up here in LA. Went to high school in the Valley.
Wait, which high school?
Oakwood. Probably the only real estate person. Actually,
Wait,
maybe the second real estate person. I'm 36. Went to Cornell for undergrad. Quickly got fascinated with real estate. I was in the hospitality program, which is really a business school.
Yeah.
And first job out of college, straight out of college, I was in real estate private equity. And I was at the same firm for almost over 13 years until I started REM.
Yeah. And what we'll talk about Walton Street. You were at Walton Street.
Yeah.
I mean, obviously a very well-known I'm sure, do they do more than real estate or
Real estate only.
really?
Yeah.
Okay. All right.
Equity and debt.
All right. So what types of transactions did you do there?
Man, anything from buying vacant office buildings to buying hotels in Europe. We did it all. Worked on casinos, apartment buildings, office, industrial, you name it. A lot of hospitality. That's probably my specialty, but we've done it all. And love the guys, love the firm. I think private equity is a fascinating area and only getting bigger, and hence why I wanted to start a platform and ultimately create our own private equity business.
So that was the first job you had out of college?
Yes, first and only.
That's amazing.
First and only. Hopefully.
I would say that's rare in these days to go 13 years from your first job. Out of law school, I worked at Latham & Watkins. I was there for 6-7 years, then Goodwin Proctor, and ended up starting my own firm after spending a couple years at Rains. And most of the real estate private equity folks that we know, I would say, have been at a few places and maybe went from the operator side to the or capital side to the operator side, or maybe brokerage. But you stayed there for 13 years.
Listen, there's something to be said for continuity.
Yeah.
And I think that compounds, just like in investing. We've known each other for a long time. And that's because we were both at the same places, running into each other at the same events, working on deals tangentially. And that just compounds over time. Those relationships compound, especially if you're in one place, because people start to get to know you and you start to really cultivate those relationships. So I love the guys. I love the platform. I had an amazing experience. They've been extremely supportive of what we're doing now at REM, and fortunate to have former colleagues join me too. And I think that's a testament to the culture of the company.
Yeah. And so it's a Chicago-based company.
Yes.
You in Chicago?
I was in Chicago for almost 8 years before opening a West Coast office, going back and forth during COVID. And until now.
Where did you live in Chicago?
I was in River North and Old Town. Amazing city, ton of fun. Nothing better than going to Wrigley in August. We would do an annual event there. Really fun memories. Easy to forget how miserable those winters are.
So Chicago's my second city. Going to Northwestern undergrad and then law school. I was just there a couple months ago for a YPO real estate event, and just being there it was 48 hours, and I just love that city. We were at Gibson's, and you could be at Gibson's any night of the week. It doesn't, regardless of season.
And how's it going?
Yeah, I mean we
martinis are flowing.
We showed up at 9 o'clock. If you show up at a restaurant in LA at 9 o'clock, it's half empty. We showed up at 9 o'clock. I had to wait for our table. It was a Tuesday night, about 8 of us, and just what a great. I think even though it's a touristy restaurant, there's still a ton of locals, and it doesn't feel contrived. It just feels like Chicago.
It's beyond authentic, and that corner is special. We actually bought the property across the street and put together an amazing Italian restaurant, and it was good for the time. For a moment. It was called Nico.
Oh, Nico.
And it didn't work. And part of the reason it didn't work is the other side of the street is so packed, it's so busy, it's very hard to replicate.
Mm-hmm.
And they've got Hugo's there too. So definitely special place, special little triangle right by our office. Spent a lot of time at Gibson's.
Yeah, no, it's a great spot. We're going to do one more story about Gibson's, and then we'll move on.
Do it.
So my wife, she was my wife. We were dating at the time. We went back for a college reunion, got in late. I said, we're going to head to Gibson's.
Yeah.
It's 11 o'clock. I mean, 11 o'clock. First of all the restaurants in LA would be closed. So we get there at 11, and my wife's a petite woman, and the waiter comes, and it was prototypical it was like just out of Saturday Night Live, like a big Chicago guy with a Chicago accent, mustache. And he says, what can I get you guys? And she says, she asks him, how is the Caesar salad? He looks at her and he says,
At 11 o'clock.
At 11 o'clock at night, and he says, ma'am, do I look like I know how the Caesar salad tastes? He said, you came to Gibson's, order a steak. She says, okay, filet it is. I mean, that's just prototypical.
Yes. Exactly. Classic.
Yeah. So let me just lean in a little bit on sort of Walton Street,
Sure.
and then we'll get to REM.
Yeah.
We do a lot of joint ventures here at Sklar Kirsh. I'd say of our clients are sponsors, operators receiving private equity money, and the other half we're representing the capital provider.
Yeah.
And
you've done an amazing job building that book.
Please, thank you. And so so when I represent operators, they're frustrated because they want to do deals with joint venture equity providers.
Yeah.
But they feel that the capital's return expectations are much higher than what reality is. Even today, like any of my operators will say, I can't get any JV money because they're looking for a net 18. I can't provide a net 18. How are any of these JV equity providers in business? So you were a JV equity provider for 13 years. And so obviously you guys did deals. Is that a fair comment on where JV equity providers are, that their return expectation is higher than what the market can deliver?
Well, first of all, at Walton Street, we were very much a direct investor, as well as allocating, but mostly I would say more direct in JVs. Mm-hmm. But we were really very close to the real estate. And I think our partners appreciated that. Other groups are more allocators and more away from the real estate, really relying on the operator. Whereas I would say, given the firm and how long it's been in business, we were much more hands-on, and that's just part of the DNA of the company and my DNA as well. Return expectations don't change with interest rates. A fund is marketed at an 18% return, whether the treasury is at 0 or 5. So you can't really risk adjust or return adjust for what the environment is. You were constantly seeking this total return. And so I think it is fair to say, like, okay, the returns that are advertised for some of these funds are not realistic, but market conditions change. Where we're at today is different than where we were 2 years ago, and 5 years ago, and when COVID hit. So it really depends on the market environment, but you can find deals that hit these return targets. I don't think that's totally fair, but the run-of-the-mill transaction, the regular way multifamily acquisition, doesn't underwrite to a 20, but it never has for the last 10 plus years. It's always been 14 to 15% levered best case. And I like to say on real numbers, not fake numbers. But yeah, I think that's somewhat fair, but you got to work a little bit harder to make the returns these days.
Yeah. And so when you sat out in Walton Street, working with all different types of operators, give me a few characteristics that you saw in operators that made it a successful partnership.
Yeah.
Versus other characteristics where it wasn't working.
Being transparent, overly communicative is very valuable. You want someone to be a good steward of your money when you're investing with someone. And when we're investing with operators, you want them to take care of your money in good times and, more importantly, in bad. And so having someone who is really communicative, who's really detailed, who's following up, who's on top of it, even if it's a little too much, I think was really valuable. And our best partnerships were the ones that were repeat customers. And like with Will Smith, who's been great and helpful to me in my new business as well. We did over 30 plus deals with Will. Harry, who I used to work with now, works with Will. That's a testament to his character, the organization that he built, and the trust that we had with him and his team, who's phenomenal. So I think that doesn't go unnoticed, and ultimately you want to do more and more business with the people who you've had good experiences with, and that's, in good times and in bad.
Now, we're not talking about the actor and the singer.
Different Will Smith.
We're talking about the Will Smith who rolls in Newport Beach with a gigantic, like not even an F-150 truck. F-150, that's his truck. And he has mentioned about hunting, and I don't know if I could hang with him. I just feel like my West Side aura just wouldn't allow me to.
You can hang as long as you got a deal.
As long as I have a deal, all right. No, what a great! I think great guy to be on the podcast. Great guy and a big USC guy for sure. If you go into his office, okay. REM. So, what led to the founding of this company?
Had an amazing experience at Walton Street. Love the guys. I really wanted to start something, and you only get one or two shots. The firm was in between funds, and I just said to the guys, I really want to start something. Will you support me? And they said yes. And transition out about a little bit over a year ago. It's quick. It's amazing how quickly time has gone. And I saw this big white space. The capital is only getting bigger. If you look at most of the funds today, I'll give you a stat. Of every dollar that gets raised, 50 cents goes to a fund over $1.5 billion. And that's just going to continue. So that'll be $2 billion, $3 billion, $4 billion. So more and more of the money is flowing to these bigger funds. Meanwhile, the operators who we were just talking about, they are not growing at the same rate as like down the street here, Ares Management. And so there's this big white space that's only getting bigger, and that's where we plan to spend time, because I think there's an opportunity to help these operators scale and also help the capital be deployed and do it in a different way. And so I think there's this big white space where we can generate, frankly, higher returns with potentially less risk in this space, which I can get into. And so that was the impetus, and saw this huge opportunity. Listen, prices are down 20%. If you lever it 60% and prices get back to $1, you're going to double your money pretty quickly. And so it's a great time to be investing. This vintage is going to be phenomenal. And, the biggest thing is there's a lot of broken deals out there. And so if we can play in this white space, if we can buy at a discount to peak value, and if we can fix broken deals and or platforms, I think we're going to do really, really well. And time will tell how much we'll grow.
So I want to get into the real estate aspect and where you fit in the capital stack.
You got it.
Before we go there, I want to just lean in on the fact that you took a leap, left a very prestigious private equity company that's known globally, a great compensation package, I assume, brokers answering your phone calls because you're with Walton Street. I have clients, a lot of people who are struggling with what to do in their next phase of their career. They're in their late 30s to early 40s, and it's like they may not be able to make that leap. I left Big Law, started this firm. You left private equity, your big private equity, you started your firm.
Yes.
I guess the question is what gave you the impetus to make the move?
I wanted to do it, and I believed in myself and what we could build in a team, and we're about to be 5 people and growing rapidly. So I think you have to believe in yourself. You have to have a level of confidence, and a little chutzpah doesn't hurt. And what's nice that I've experienced, and going back to the value of compounding relationships, I didn't know how people were going to treat me leaving, right? You don't have this fancy business card anymore. So it's really important that you have your own enterprise value, not Blackstone or Walton Street or Sklar Kirsh. Like, you are your own person. And the reason I bring that up is I didn't know who was going to be my friends pre and post my leaving my job and starting a new platform. And what I've been pleasantly surprised by is I have a lot more friends than I thought I did, including you. And you just don't know how people are going to treat you. And I've been pleasantly surprised to the upside. And again, I think that has to do with the compounding of those relationships over time.
Yeah. And I assume your wife was fully on board, or
Very
because
supportive.
oftentimes the people that I'm representing,
Most important piece.
it's their wife who's like, I'm a little nervous. I don't know. You have kids?
Yes, I have 2 kids.
Yeah.
It was just going to get, it was only going to get harder.
Yep.
I just had my second child when I left, and did not have anything formally lined out. But I really wanted to do, I really believed in myself. I really had the support of everyone around me, as I mentioned, and I did it. I don't think that this is for everyone. I think a lot of people will make this leap and not be successful. I think you have to be extremely resilient and have a lot of perseverance.
Yeah. All right. Now let's dig into the real estate and what you guys are doing. So talk about, where's REM fitting in the cap stack? Is it providing capital to others? Is it doing its own deals direct? Types of asset classes, all of the above? I know this could be like a 10-minute answer to this question. So let's just start with, are you buying deals direct? Are you providing capital like Walton Street?
So at Walton Street, we were both a direct investor and a allocator, debt and equity. Okay. So this is an extension of what we were doing, but in a different way. We are investing directly or partnering with operators or backing platforms. So we can do a lot of different things, hence range. I'll tell you what we're not doing. A 10-year lease to Amazon, I'm not your guy. If I was smart, maybe I would be. That seems a lot easier than what we're doing. We're doing a lot of complicated deals. We are looking at backing platforms. We're looking at distressed situations. We're looking at co-GP opportunities. We're looking at ways we can generate alpha and excess return. We are not investing to make 7 or 8% returns. Everything we're doing is high double digit, 20 plus type return expectations, and that's because we're investing our own capital. We want to make high returns.
Mm-hmm. And I'm sorry,
go ahead.
And what about the asset classes?
So I would say that our focus is on operating assets. So again, the 10-year lease to Amazon, that is basically a bond, right? You are buying a fixed coupon for 10 years. We are doing the complete opposite. We want levers to pull. We want to come into a deal in a very creative way or a platform. We want to grow cash flows as quickly as possible. I'm not a big fan of relying on lower exit cap rates these days or lower financing rates. I want to actually grow NOI. And we want to come into deals in a creative way so that hopefully maybe at something that has a value of $1, we're coming in at 90 cents. And I can get into sort of how we do that while we grow the cash flows. We're looking at operating assets, hospitality, residential, certain types of housing. We're starting to look at senior housing, for example, and everything in between. But think levers to pull, operating assets. We're stock pickers. We're not buying bonds.
And what about ground up construction?
We would look at it. New development is hard. Basically, every new development deal underwrites to a 6% return on cost or lower.
Even if my clients say it's a 7.
On fake numbers, maybe it's a 7. On my numbers, it's a 6. And so it's very hard to justify new construction. Plus, you can buy below replacement cost. So why would I develop? That said, for certain very special real estate, like the Century City office tower right here, there's a place for it. It's incredible real estate, or it's highly differentiated. So we'll look at development, or if there's an interesting way for us to get in the development, like in preferred equity or mezzanine debt. But generally, development's tough right now.
And so what about the capital that's behind you? How did you form a fund? Do you have programmatic relationships? The types of capital, is it institution? Is it family office? How did you get that?
We're really good at complex deals, and we have relationships across the landscape with family offices, private equity firms, high net worth individuals, RIAs, you name it. And so we're able to tap into those relationships for each deal. And I thought that was really important. In order to get our range, in order to do different things, you have to have different capital sources because it's different strokes for different folks. And that, again, going back to the compounding of those relationships, we've met a lot of people over many years of being in this business. And as a result, I've been able to leverage those. So I'm working on deals with different friends of ours in the industry, depending on the transaction. And then we have access to some kind of different capital sources, such as family offices, that have a longer term horizon that can do things that others can't. And I think that's incredibly valuable today because we see a lot of different opportunities that we think are interesting, and we have different capital sources in order to take advantage of them. Private equity is great at bucketing strategies, core plus, debt, equity, opportunistic, industrial, core, multifamily in the Sun Belt. You name it, there's a product for it. We are more agnostic. We don't want to have 10 different buckets. We have one bucket, but we want to go to where the best opportunities are. So that's generally what we're doing, which makes it hard. Our world and our aperture is very wide right now. We can do a lot of different things.
I had Jeff Kirsh on the show last week, and I asked him, I'm going to ask you the same question I asked him.
All right, buddy.
So you're doing so many different asset classes.
Yes.
You play throughout the cap stack.
Yes.
You could be on the debt side. You could be JV equity. You could be co-GP. You could be platform equity. What is your inbox like? I mean, how should people think of you? Because you're not in a narrow box.
We are really good at complexity. Again, 10-year lease to Amazon, I'm not your guy. Broken capital structure, distressed debt, foreclosure, bankruptcy, you got the right person. And so we are, again, looking for levers to pull, looking for complexity where we can provide an advantage, a unique a unique situation. A fully marketed process where someone's going to pay the highest price for an asset, you're probably not going to find us in.
Yeah.
It's a recapitalization, it's distressed debt, maybe it's a platform that's looking for new equity, something that is more creative. That's where you're going to find us. I would say most of what we're doing is residential hospitality. That said, I might buy an office building, might buy the debt on some office buildings. We'll see. I'm actually pretty optimistic about what I'm seeing in that space. So we can play in a lot of different sectors. We kind of know what we like, to answer your question.
Yeah.
But it's hard.
Can you talk about a couple deals?
And fun.
Yeah, of course. Can you talk about a couple deals that you have closed on?
Yeah. So the first investment that we made post-forming was $100 million rescue financing of a ski resort. It was in Snowmass, Colorado, outside of Aspen.
Oh.
And the owners, I happen to know, friends of ours, and they were facing a foreclosure and they were over leveraged, but they had what I call a value rich asset with not a lot of cash flow. So cash poor, value rich. And it's 6 acres, ski in, ski out, Snowmass, Colorado. We ended up providing them with a new loan to take out their existing debt prior to a foreclosure so that they could stabilize the property and sell it significantly more than their debt, which had matured. And so we did that. We brought in our friends at Oak Tree Capital to be our partners, who were wonderful and want to do more with us, and we want to do more with them. And ultimately rescued this project, and the project was sold in just in April. So we realized our first investment in 4 months.
I assume Cloud9 is not part of the collateral, but I know, but I hope you guys got to Cloud9 as a closing celebration.
Hopefully we'll get to do that this winter. The deal cycled out so quickly, we didn't get to have a closing dinner.
Have you heard of the legendary Cloud9 trips that Carol Wood has put together the last couple of years?
I have not.
Well, you need to transact with my friends, and they've done it multiple years. As it started as a closing celebration after the closing of the Aon building, and given their activity that we have now, we may be going back a couple times.
I love it. Special place.
Yeah,
a lot of fun.
It's pretty crazy.
So what was interesting about that deal was it was off market. It was a special situation transaction. We created kind of a bespoke solution for the ownership group, and it was special real estate, 6 acres on the beach, so to speak, on the mountain. It was really unique. But the cash flow was impaired for various reasons. And so we saw a lot of value, but it was cash flow poor. And so could we provide sort of a gap financing? And that's what we ultimately did. This problem exists everywhere. Multifamily, office, hotel, you name it. Every asset class has this problem. And that's because interest rates have gone up, leverage has come down, and there needs to be a gap. So we're finding a lot of those opportunities elsewhere.
I mean,
So that was our first deal.
That's congratulations.
Thanks.
Look, since mid 22,
Yeah.
everyone has talked about the tidal wave of distressed opportunities that we're gonna see. We've seen distressed opportunities specifically in office,
Yeah.
and maybe some other situations like
Hotel.
what you just hotels for sure. It hasn't really come in multi. It hasn't really come in other asset classes. The going back to probably when you were starting, when was your first year at Walton Street?
11.
11.
Yeah.
Okay, so
Coming out of the GFC.
yeah, so that period from like 10, 11, 12, every day I was inundated with loan portfolio
I
acquisition.
remember every week.
Every
Loan
month.
sales.
And they would say, hey, Kirsh, we literally have like 24 hours to go non-refundable to buy like 500 notes. You just got to do just some diligence just to make sure there's no nuclear missiles. And my clients were just like picking up these loan portfolios, tapes for cheap.
Yeah.
Haven't seen that here. One-off loan sales in office,
Mhm.
maybe a couple multi-deals. So what's different today?
Well, this is a longer cycle. It's a U, right? Much deeper, longer U. Back then was a V, right? And so you had banks just clearing out this credit left and right.
Yep.
And taking their lumps and moving on. This is just going to take longer, which is why I'm so excited, because this is a huge opportunity that's going to be here for years. It's just less vicious than what you're describing. I think that we are early innings in the distress cycle still. And I'll give you a reason, or I'll give you a stat. What do you think the delinquency rate is in office?
For all loans or CMBS or
Yeah, all sure. One in the same. For office specifically. Take a guess.
35%.
No. You got a second guess? Because that's way off.
Yeah. 85%.
10%.
Oh, okay.
10%. I don't know that I could name 10 buildings that aren't impaired in like the city of Los Angeles, for example. So I think that rate is going to go up to the levels, I don't know about 80, but to 30%. That could happen. It's possible. We'll see. It depends. But ultimately, that is indicative of early stage distress innings.
Well, we talk about impairment,
Yeah.
And the issue that a lot of my clients are facing, maybe not in LA, but in other markets, where the office building is cash flowing and they're leasing and they're getting good rents, but when their loan comes due, they're effed because the cap rates
values are down 40%.
Right. So I guess maybe I didn't understand your question, because the impairment is pervasive, but the technical delinquency, you're right.
If you have cash flow, you'll keep paying interest.
Sure. LA, downtown LA, Portland, Seattle, San Francisco back on the rise. We're seeing a DSCR issue.
Yeah. You need a forced seller. You need a forced lender, a forced seller. And you just, like I said, it hasn't been as vicious, but it will come. It will absolutely come. Absent some massive rent growth, demand recovery, it will come. It just takes time. And this is why we're so excited about what we're seeing. We are in active discussions about buying debt, providing debt. We just bought a multifamily property in Portland. And the reason that we bought it is the seller had a low maturity. They didn't want to put new equity in. And they took a significant loss from where their basis was, but they were okay moving on because it was small in the scheme of their portfolio.
So I love hearing that about Portland specifically, because, I help raise capital for clients of mine and I send you deals that you shit on all the time. But
Not true.
So
Sometimes.
I would say in the last 30 days, I had multiple multifamily opportunities in Seattle and Portland that I took to my capital providers. I probably went 0 for 30. All had the same response. No on the Pacific Northwest. Similar response if the asset was in LA. No on LA. Now, all of these groups they have a herd mentality. And then it takes private capital, entrepreneurial capital who recognizes that it's just great value, great basis, and that you're not concerned about being in a blue state, the ultimate blue city in a blue state?
I think you have to look at the data. The headlines are misleading. You go to Portland today, you go walk around downtown, it's not that bad. It really is. It's not that significantly different than Chicago or than LA or other major CBDs around the country. There are certainly issues, no question. Doesn't have the same demand growth as other markets like Austin or South Florida. But, you know, price is what you pay, value is what you get. And so ultimately, are you getting good value for what you're paying? We think so. We're getting 100+ basis point cap rate premium to what we can get in other markets, and we have 100% leased assets. So I think you have to look beyond the headlines. There's actually positive population growth, believe it or not, in Portland, not negative. And I think things are turning. There's new governance there. We'll see. I think the same is true in San Francisco. The capital markets definitely have reacted laser quick.
Yep.
And you've seen a lot of trades there recently. But you have to go a little bit against the grain sometimes.
But it's hard. These larger equity groups, they just cannot.
Well, putting my private equity hat on from my prior life, it's always about marketing, right? And about the next fund. And I think it's really challenging when you're taking your lumps in an asset class to go double down in your next fund. And I think everyone goes through it because of what you're saying. It's just like the herd mentality, and it's about marketing. But I think there's great, interesting buys out there if you're a little contrarian.
So I'm curious if what you're experiencing is similar to what we're experiencing at Sklar Kirsh in terms of the volume and activity of transactions.
Mm-hmm.
So the fourth quarter of 24, we were really busy. And then end of the year, and this was also, the election occurred, Trump wins, everyone is bullish about capital markets, and our November, December was extremely busy. Turn into 25, fires occurred. Now that's a micro LA issue, but it does affect things because a lot of the players are in LA. Trump announces tariffs, even though we all knew that those were coming. I guess we were a little shocked, or the capital markets were shocked at the severity initially. And then I would say around late April, early May, in the last 60, 90 days, we have been as busy as we've been since 21, early 22, in those crazy 18 months. Curious if you're seeing the same thing of just the volume of transactions. I mean, you see my board. I mean, we're active. We are actively needing more attorneys to meet the demand of the transactional volume. I have not had to do that in over 3 years.
There is an incredible buildup of deals that need to sell, whether it's in legacy funds, whether it's lenders that are taking over assets, owners that are impaired. There is just going to be a flood of deals. And the refinancing market is so strong right now, and was up until Liberation Day, that there's just a huge flood of deals either getting refied or will ultimately get sold. So I expect volume is going to continue to pick up. You have a lot of tailwinds. Short rates are going to go down. Supply is falling off a cliff. Demand is still steady. Cap rates probably have peaked. I think there's going to be a lot more deal flow. Everybody generally has capital. I talk to a lot of investors as we prepare to raise our own fund, and everyone has capital. I think they're waiting for more distributions to then go recycle and reinvest. But there's no shortage of capital out there. It's the shortage of deals, and deal flow is anemic because people don't want to sell at these prices.
But rates haven't really changed over the last several months.
No, but they're going to go down. I think that short rates will go down.
You talk to your friend Powell.
I think that long rates will probably go up, if I had to guess. I think you're going to see a steeper curve. Mm-hmm. And that's good for what we do. I think it's going to be harder for long-term leased assets personally. But if you're growing cash flow and you have short rates and you're able to realize some NOI growth, I think it's good for real estate.
Yeah. So when you're starting your company, mm-hmm. and you have obviously your reputation, Andrew Gindy is you walk around these streets of Century City and everyone stops and wants to talk to you because of the reputation that you've built.
Thanks,
and the brand
LJ.
that you've built.
Kishka.
Yeah, but you still have to make if you're doing deals with, or when you're doing deals with brokers or doing deals with operators and sponsors, you need to get them to feel comfortable that Gindy's going to be there at the closing with the capital that he says, whether it's a broker or seller or an operator. You haven't formed a fund. Curious why. Do you feel like it wasn't necessary that your relationships of capital was so strong and your relationships with your counterparties were so strong that when you go into a sushi bar and you look at the sign of "Trust Me" for the omakase, it's a little bit like that.
I think you got to take it very seriously, and you can lose it in a heartbeat. I was just talking to my team about this yesterday. Reputation is everything. And again, I was pleasantly surprised by how people have treated me and my firm pre and post leaving my prior position. You have to perform, especially those early deals. You may have to overpay a little bit too. As one of my favorite brokers said to me, he's like, "I'm happy to sell you something. Just know you're going to pay the highest price." Okay. And I said, "Yeah, I know." And so, like in the first deal, in the deal in Colorado, very complicated, $100 million, lots of different parties. We put it all together. We closed. Took a lot of hustle, a lot of perseverance, and some really strong relationships. So ultimately, you got to believe in yourself. You got to get it done, and you got to have these really strong relationships. I think that the trust me factor is big.
Yeah,
I do. And I think that has to do with all the people we know in this business who want to do business with us.
Yeah. All right. So my final question for you now, 36 years old, you're not like me, who, by the way, this is my last podcast in my 40s. I turn 50 next week, so it'll be published when I'm 50. But
not bad, LJ.
Not bad. Have my physical, everything looks.
You look good.
Thank you.
Northwestern's finest.
So the question I have for you, 36 years old, you've been in the business, 14 years or so. I'm sure you get, you have conversations with those that are coming out of college or maybe coming out of business school. And we're in an interesting market that we talked about. Mm-hmm. Where would you suggest a 22-year-old Andrew Gindy graduating from Cornell, of course, I'm sure the top of his class, where should he start or she start in the real estate business? Is it brokerage? Is it private equity? Is it operator? What would it be?
For me, I tried a bunch of different roles: operations, lending, at a bank, developer. I realized really quickly I wanted to be on the private equity side. That's why I was in private equity ever since I graduated. And so you got to try out different things, see what you like, but you have to follow your passion. I think passion is number one, your North Star, and where you have to focus and where you gravitate to. That may sound cliche, but it's true. And so I was really passionate about the business, especially in private equity. Being the holder of the capital was the most interesting place to be for me around the table. But there's merit to all these different seats, but you have to figure out what you're passionate about. That's the most important thing.
Yeah, absolutely. Well, look, I appreciate you making the long trek to my office from next door.
My pleasure.
We have to do another lunch like we did when we finished 20. Oh my God. Can you imagine how life was so different?
Slightly different.
December 24 versus January 25, but an epic lunch that we had with our good friend Schwartzman. And I think, was it Sam Averback who was our,
Shmuley.
Rabbi Shmuley. But you're one of the pillars of our real estate LA community. And I'm just honored to have you on the show.
Thanks for having me.
All right, man. All right. That's another episode of Real Talk.
You've been listening to Real Talk, Real Estate Discussions with Andrew Kirsh. You can catch prior episodes at sklarkirsh.com and on YouTube, LinkedIn, Apple Podcasts, Spotify, Google Podcasts, and more. Thank you for your positive reviews, comments, and for sharing the show with others.